Hello, everybody, and welcome to the IX Trading Room with me, Richard Perry, Market Analyst for INFINOX. Now, before I get into this, obviously we've got a lot to get through, but before I get into it, I need to do the bit of housekeeping and I need to talk about the disclaimer because I'm going to be discussing live market information, and because of that, you need to understand that all I'm going to be talking about is information and it's not to be construed as investment advice. Very, very, very important that you understand that. I'm not going to be giving investment advice whatsoever. Anything I talk about is for your information and for you to take away to then use as you will and you see fit. So yeah, please understand that. But I wish you welcome to today's webinar. It is an interesting day in major markets. We've got, as I said in the video I've just posted on Instagram, I've got a lot to get through. I'm going to be talking about the Fed. I'm going to be talking about Bank of Canada, a little bit about Bank of Canada, all the market impact of that. We're going to be looking at some trades potentially, and also looking ahead to the Nonfarm Payrolls report on Friday and also Tuesday's inflation data. So let's kick off with the Federal Reserve. Jerome Powell had his congressional testimony yesterday. Basically what he did was he went hawkish. Now, hawkish means that he's raised expectations of higher and higher and higher US Federal Reserve monetary policy. And what does that mean to markets? Well, first of all, I'm going to show you this line here. This is the expectations of where the Federal Reserve interest rates will peak. Now, they're currently a little bit down today, but currently well over 5.5%. Now, I did read that BlackRock, the big US investment house, is thinking that rates might even hit 6%. Now, at the moment, markets are pricing, you might have just seen this at the beginning, markets are pricing for interest rates to hit just over 5.5%. You can see here an 80% probability of hitting 5.5%, over 5.5%. That is basically where they see it, markets seeing it peaking and then over the top. Interestingly, before that, for March, this is the CME Group Fed Funds Futures Fed Watch. 75% probability of a 50 basis points rate hike in March. So this all means that the dollar is strong. Now, not that, Richard. I just turned off the one thing that I need to see. Is that so? Yeah, markets are seeing that the dollar is stronger dollar, as you can see here in this chart of dollar index. Broke decisively high yesterday and he's holding on to that move today. A little bit of a sort of little unwind earlier, as you can see here, a little bit of an unwind. We can see euro positive, sterling positive, also Aussie and Kiwi positive, but the main takeaway is that the dollar has strengthened significantly as US Treasury yields have increased. Now, the US 2-year Treasury yield has moved above the 5% mark, just a slight underneath today, but essentially what we're seeing is this is a key move that could well continue. As I said, 80% probability of a 5.5% rate hike. Now, that has room to go to 100% probability. You got 75% probability of a 50 basis points rate hike in March. That has room to go to 100%. So there's more room in this current dollar move potentially. However, a little bit stretched on the immediate move. And we can see that if you look at this is the IX1 trading platform, by the way. Anyone who's interested in the INFINOX trading platform, this is the one that I really like. We also have MT4 and MT5 for people who are a little bit less confident in potentially using a new trading platform. However, this is the one that I really like. Anyway, IX1 trading platform, you can see here, euro dollar sharply lower yesterday, a little bit of an uptick today, but generally speaking, euro dollar is negatively configured on momentum and sort of lower highs, lower lows, pushing towards a test of that key support at 104.80. That is where we're looking at here, I think, on euro dollar. Let me take that full screen just to give you a better view of it. You can see that there. I think euro dollar is coming back here, a little bit of an uptick today, but this falling over yesterday and the resistance that it's found at sort of 106.90 in the last few days really does suggest to me that it is sort of falling over. Euro dollar downside is not the one I would be playing though. I much prefer sterling dollar to the downside. I think sterling dollar is a better has better downside potential. Look at this double top pattern. Doesn't happen often, this sort of pattern in analysis. You don't get big patterns, big double tops. You get small ones on nearer term charts, but this is a big one. And this is a very well constructed one. It actually did complete the pattern yesterday on a move below 118.40. Actually closed at 118.25 yesterday. Did a bit of an uptick, but let me show you in sort of better detail, full screen, and then just zoom in a little bit. You can see here, you've got this band of resistance. I think now between the level between 119.10 and 120.65. So you've got basically 150 pips worth of resistance. I think that is where you see this. Look at these moving averages, both falling over. Look at the 21-day moving average, now consistently sort of a basis of resistance. 55-day moving average, having been supportive, is now become resistance in the recent few weeks. So it all suggests, with this momentum on the daily RSI as well, consistently under 50, all points towards selling into strength. Now, we might have a little near-term rebound on sterling dollar, and we've had a little one today. However, I think that would be probable selling opportunity. Bang into the middle of this sell zone, I think would be ideal. And I'm going to look at this in a little bit more detail later on with a potential trade here. In fact, no, let's do it now. What we have at the moment, I think, is the potential for, having seen the breakdown, a little bit of a near-term technical rally. I think the lower highs that we've got in place here, consistently lower highs underneath this 21-day moving average, I think that all suggests that is a sell into strength. So I would say there is the possibility for a trade here. So I'm going to sort of put this on to, it's a sell trade, sterling dollar sell, and I'm going to say that is big, because basically what I would like to do is like to sell into a rally. So sell into the resistance of the rally. So to do that, that is a sell limit order, where the market unwinds to a price, fills the trade, and then falls away. That is a sell limit order. So sell limit order, and the price I was thinking of doing, I've written it here, 119.50. So it gives a little bit of room for a technical rally. This is not a trade that I'm looking to put on immediately. This is a trade to have sort of in the locker, really. 119.50. Now, different options that I've got with the IX1 trading platform. I can do a lot size, I can do percentage of equity, cash risk, all sorts of things. But I'm going to do lots, and I'll actually change the lot size in a minute, because basically I'm going to calculate it off the size of the trade that I need to have. At 19.50, I want to have a stop loss above the reaction high that we had yesterday. That reaction high yesterday, 120.65. So there's sort of different options I could have here. I could have that just above the stop. I would suggest give it a little bit of room. And again, for the stop loss, I've got potential for pips. I can put the price in, so I could have the price at 119, say 119.80. That would give me 130 pips of stop loss. So 130 pips of stop loss. For that, I'm actually looking for a retest coming back towards this reaction high here. So get the crosshair. I'll show you this reaction high. This old reaction high was 116.50. So basically 119.50 to 116.50, 300 pips. It's a pretty good potential for a move lower, I think, in that there. So I could either choose 300 pips, or I could do a price. And I'm going to have 116.50. Now, for the trade size, this is the interesting one, because, okay, look down here. Look at down here. I've got, for a trade size here of 0.1 lots. I have a trade size, take profit of 300 pips. Oh no, sorry, 120.80. Sorry, that was my mistake. 120.80. You can see here, this is the stop loss. Sorry, the amount of exposure to the trade has changed. At this trade size, one mini lot, I am risking $130 on this trade. That is a big punchy trade for me. I mean, say for example, if I've got a trade account of say $1,000, $130 of risk on that account, that's 13% of my trading account. It's a big chunk of my account gone if I get this trade wrong. So I'm going to reduce the lot size. 0.03. What does that give me? $40 for $90 worth of profit. I think that's a bit more agreeable. You see here the levels are already in here. Stop loss 120.80. Take profit down here, and here is the entry point. So I'm going to place that trade. Now that is a trade that sits pending orders. You see here, down here, pending order. Now you might have seen a trade I did last week. I got a little bit done last week, but I'm still in the trade. You can see here, gold. I'm actually $30 down. I went long at gold last week. Let me show you gold on a little mini breakout, but I put the stop underneath the reaction low, so I'm still in this trade. So I'm okay at the moment. I'm not massively happy about it, but I'm still okay, still alive, which is good. Right, I'm sort of needing to get through this a little bit. So right, I've done sterling dollar and euro dollar impact. We're on to gold. We can see that basically that hawkish move from Jerome Powell has hit the outlook for commodities. We've seen precious metals coming lower, gold lower, silver lower, silver even further lower than gold. Sharp move to the downside on silver. See these lower highs and lower lows. Again, that would point to selling into strength. You get these selling phases and then a little bit of a rebound. You can see here, old support becomes the basis of new resistance. So that's interesting. So silver, for example, 2045 is a level that I'd be looking at there. Potential resistance coming in there. Equity markets as well. Look at US futures. Fell quite sharply yesterday. A little bit of a consolidation today, but I mean, that's not a great candlestick setup. I don't really want to call it an evening star because it's not really at the top of an uptrend. But you can see that the sort of strong bull candle in, basically neutral candle, strong negative candle out. That is a bearish pattern for me. And it's likely that US futures is going to come back lower now, I think. Strong dollar, negative on equities, negative on commodities, basically is what we've got from Powell. Right, quickly moving on to the Bank of Canada. Wow, Bank of Canada sat on its hands today, didn't do anything, 4.5% on its interest rates. Interesting that it's talking about restrictive monetary policy biting into household spending. That, I think, would suggest that it's pretty much done for the time being now. The next move is likely to be lower rather than higher. And we can see that CAD is weakening on that, dollar CAD moving higher. The one major currency pair that the dollar is strengthening on today is the Canadian dollar. So we can see that moving higher. Right, okay, looking ahead to Friday, payrolls. Basically, Jerome Powell pretty much set the markets up for looking at data, big time looking at data. So that really does put the focus now on to Friday's non-farm payrolls. See here, this is the calendar on the INFINOX website, by the way, not the IX1 platform, although I can get a calendar on that. This is the calendar on the INFINOX website, and I've just filtered it basically for US data. We can see here that we've had the jobs openings. They came out stronger than expected. Tomorrow's just jobless claims, really. But Friday is non-farm payrolls. That is the big one, non-farm payrolls. It's expected to go from 517 down to 203. That's a pretty big fall, but generally speaking, it's back towards the sort of 200 area. It's sort of considered that maybe January was a little bit of an anomaly. I mean, it did have, a massive 200,000 jobs above where sort of pretty much the top expectation was. Now, interestingly, looking at the consensus, the range of consensus is 100,000 up towards, I think, 325. So it's a pretty big band there for potential surprises. Bearing in mind, it's difficult to know because, warm weather certainly helped the jobs market in January. So I think weather's continued to be fairly decent in the States. So that might, again, help to add into jobs growth. But yeah, another strong payrolls report on Friday, and you'll see the dollar moving sharply higher, I can imagine. So that would be the risk there. Tuesday's inflation data, again, another really important one. Basically, you've got payrolls on Friday, and then on Tuesday, you've got the CPI, the US inflation numbers. Now, Federal Reserve is on Wednesday of, 22nd of March, Wednesday 22nd. So these are the two big data points really before, you've got retail sales. But yeah, generally speaking, these are the big ones, non-farm payrolls and US CPI inflation. CPI inflation expected to come slightly lower on both core and headline. But it'll be very interesting to see how the month-on-month data goes. That was sticky last month. Again, sticky inflation plays into this whole factor that the Federal Reserve will be tighter for longer. Right. One more thing, Bank of Japan on Friday. It's unlikely that we're going to get any real interesting move out of the Bank of Japan. It is Governor Kuroda's last meeting. He's not going to do anything crazy. Any sort of changes to monetary policy are going to come from the new guy, Ueda. So that pretty much sort of wraps it all up. But what we have seen, as I said, is dollar strengthening, equity market sort of pulling lower. It looks like dollar is going to be a buy into weakness once more. So any sort of movement lower in the dollar, I think, is likely to be an opportunity. I would see that as an opportunity probably to buy dollar positions. So therefore, I'd be looking at selling the likes of euro dollar into strength, selling the likes of sterling dollar into strength, all things like this. That would be what I'd be looking out for. Volatility on Friday with the payrolls report, that's certainly, given the fact that what we had last month, we're going highly likely to see volatility on that payrolls report on Friday. So be careful about that. Right, okay, so thank you very much for coming today. Lots and lots I've had to get through to try and sort everything out. So yeah, lots to think about here. But what I'm going to do is I'm going to just share with you okay. Need to just, what am I doing? I'm looking for something. Right, find that. Interesting. Okay, so yeah, I wish you good luck. Don't forget, you can join the YouTube channel by just clicking on the bell, and you get notifications for our YouTube on our IX Trading Room Live. So come and join me there. But in the meantime, I definitely wish you good luck in your trading, and I will speak to you next time. And what I will do is I will leave you with a little bit of a video where it sort of shows what we're about and shows you a little bit more about the IX Trading Room. So I will leave you with that video. So yes, wish you good luck in your trading, and I will speak to you next time.